Ladies and gentlemen, Mr. AG here. As of February 12th, 2026, I want to direct your attention to a data point that I believe captures the state of the global silver market more precisely than any price chart, any analyst forecast, or any geopolitical headline could. On February 9th, silver inventories held on the Shanghai Futures Exchange fell to 318.546 tons. That is the lowest level recorded on that exchange in nearly a decade. To put that figure in its proper context, now, I open with this data point not because Shanghai is the only exchange that matters in the global silver market, but because the SHFE inventory trajectory encapsulates, in a single measurable series, the fundamental imbalance that has defined silver for the better part of this decade. This is a market that has been in structural deficit for 5 consecutive years, and, according to the Silver Institute's latest report, is poised to extend that streak to a 6th in 2026. That is not a cyclical fluctuation. That is not a temporary mismatch caused by a one-off supply disruption or a speculative demand spike. That is a chronic, persistent, and deepening imbalance between how much silver the world produces and how much the world consumes. And the inventory data from Shanghai, from London, from COMEX, all of it is simply the physical accounting of that imbalance made visible. Every ton withdrawn from an exchange vault is a ton that was demanded by someone and supplied by no one through current production. It came from the stockpile because the mine could not deliver it. And when you drain 89% of a major exchange's inventory in 5 years, you are not witnessing a market in equilibrium. You are witnessing a market that has been borrowing from its reserves to maintain the illusion of adequacy and is now approaching the point where the reserves themselves begin to question how much longer they can sustain the drawdown. Let me walk you through the broader supply and demand framework, because the Shanghai inventory figure, as striking as it is, becomes far more significant when placed within the global context that the Silver Institute has now formally documented. The Institute's latest report, released in early 2026 and covering projections for the full calendar year, confirms that the global silver market is expected to post a deficit of approximately 67 million ounces in 2026. That figure, while substantial in absolute terms, actually represents a narrowing relative to the deficits recorded in 2023, 2024, and 2025, which range from approximately 140 million ounces to over 230 million ounces, depending on the year and the methodology employed. The narrowing is driven not by a resolution of the underlying imbalance, but by a combination of modestly higher supply and a compositional shift in demand that has partially offset continued growth in certain categories. On the supply side, the Silver Institute projects total global silver output to rise approximately 1.5% in 2026 to a decade high of 1.05 billion ounces. That is a meaningful milestone and one that deserves proper acknowledgement. After years of stagnant or declining output, the global mining industry is beginning to deliver incremental production growth. New projects that were financed during the 2023 and 2024 period are starting to contribute ounces. Existing operations that invested in expansion and efficiency programs are seeing those investments translate into higher throughput. And recycling supply, which accounts for a significant portion of total secondary output, has responded to elevated prices with modestly higher recovery volumes. The 1.05 billion ounce figure, if achieved, would represent the highest annual production total since the mid-2010s and would mark a genuine break from the supply stagnation that characterized the 2017 through 2024 period. However, and this is the critical qualifier, 1.05 billion ounces of supply against projected demand that keeps the market in a 67 million ounce deficit means that even at decade-high production, the world is still not producing enough silver to meet its own consumption. The supply response is real. It is just insufficient. Let me break that supply number down further because the composition matters as much as the aggregate. Mine production, which constitutes the largest component of total supply, has been constrained by the same factors I have discussed in previous analyses. Grade depletion at major operations continues to erode per ton metal recovery. The byproduct nature of approximately 70 to 72% of global silver mine production means that silver output is largely determined by investment decisions in the gold, copper, lead, and zinc sectors, rather than by the silver price itself. And the permitting and development timelines for new silver-bearing deposits remain measured in years, not quarters. The fact that mine production is rising at all is encouraging, but the 1.5% growth rate needs to be contextualized against the scale of the deficit it is attempting to close. At 67 million ounces, the projected 2026 deficit represents roughly 6.4% of total supply. Closing that gap through mine production growth alone would require sustained annual increases well above current rates for multiple consecutive years. That is not impossible, but neither is it probable given the structural constraints on new project development and the declining grade trajectory at existing operations. On the demand side, the Silver Institute's 2026 projections reveal a market in transition, one where the composition of demand is shifting in ways that carry significant implications for price dynamics and market stability. Total global silver demand is projected to remain largely unchanged from 2025 levels. That flat aggregate, however, masks substantial divergences across individual demand categories. Physical investment demand, which encompasses retail purchases of coins, bars, and rounds, is expected to surge 20% to approximately 227 million ounces, a 3-year high. This is the category where the evidence of retail conviction is most directly measurable. When individual investors are increasing their physical silver purchases by 20% in a year when prices have already more than doubled, it tells you something fundamental about the depth and durability of the demand impulse driving this market. These buyers are not chasing momentum. They are expressing a view about the long-term value proposition of holding physical metal, and that view has proven resistant to the kind of price volatility that would normally shake out speculative participation. The 227 million ounce figure for physical investment is not a marginal adjustment. It represents roughly 22% of total projected supply for 2026, when a single demand category consumes more than a fifth of total production, and when that category is growing at 20% annually, the implications for the remaining supply available to satisfy all other demand segments are arithmetically severe. But while physical investment demand is surging, other categories are contracting, and the reasons for that contraction are important to understand because they reveal the mechanisms through which higher prices are beginning to interact with the demand landscape. Jewelry demand is projected to decline approximately 9% in 2026. Silverware demand, a category that is particularly price sensitive in key markets like India, is forecast to fall 17%. These are meaningful reductions that reflect genuine demand destruction. When silver moves from $25 to $60 and beyond, consumers in price-sensitive end markets respond by purchasing less, substituting alternative materials, or delaying purchases entirely. This is the self-correcting mechanism that classical economics predicts, and it is functioning exactly as theory suggests it should. The question, however, is whether the demand destruction in discretionary categories like jewelry and silverware is sufficient to offset the demand growth in non-discretionary categories like physical investment and industrial applications. And the Silver Institute's data answers that question definitively. It is not. The 67 million ounce deficit persists despite the contraction in jewelry and silverware, because the growth in investment demand and the resilience of core industrial demand more than compensate for the losses in discretionary segments. The industrial demand story is where the nuance becomes most important, and where I believe many observers are drawing incomplete conclusions from the data. The Silver Institute projects that industrial silver consumption will ease modestly in 2026. At first glance, this appears to contradict the structural demand growth thesis that has underpinned much of the silver bull case over the past several years. If solar installations are still expanding, if electrification is still accelerating, if 5G deployment is still rolling out, how can industrial demand be declining? The answer lies in a word that appears repeatedly in the Institute's analysis, and that deserves careful examination: thrifting. Thrifting, in the context of industrial silver consumption, refers to the ongoing effort by manufacturers to reduce the amount of silver used per unit of output. In the solar photovoltaic industry, this manifests as a reduction in the milligrams of silver paste applied per solar cell. In electronics, it appears as the miniaturization of silver-containing components and the substitution of alternative conductive materials in non-critical applications. In brazing alloys and industrial catalysts, it shows up as reformulated compositions that achieve comparable performance with lower silver content. The thrifting trend is real, it is accelerating, and it is being driven by the same price signals that are causing demand destruction in jewelry and silverware. When silver was $15 per ounce, solar cell manufacturers had limited economic incentive to invest in reducing their silver consumption per watt. At $60 per ounce, and with silver paste representing an increasingly material component of total cell cost, the incentive to thrift has become substantial. Every major solar cell manufacturer, from LONGi Green Energy to JA Solar to Trina Solar, has active programs aimed at reducing silver loadings. The transition from PERC to TOPCon to heterojunction cell architectures has, among other benefits, enabled meaningful reductions in silver consumption per cell, and emerging technologies, including silver-free metallization approaches using copper plating and alternative conductive pastes, are progressing through development pipelines with increasing urgency now that silver prices have reached levels that materially impact module economics. However, and this is where the analysis requires precision, thrifting to date has not been sufficient to offset the volume growth in solar installations. Global solar photovoltaic capacity additions in 2025 exceeded 500 gigawatts, roughly double the level achieved in 2022. Even with silver loadings per cell declining by 8 to 12% annually in recent years, the sheer volume of new installations has driven total solar silver demand higher in each of the past 5 years. The Silver Institute's projection that industrial demand will ease modestly in 2026 suggests that 2026 may be the year where thrifting gains begin to genuinely offset volume growth on a net basis. That would be a significant inflection point if it materializes, and it bears close monitoring throughout the year. But even if industrial demand does decline modestly, the surplus freed up by that decline is being more than absorbed by the 20% surge in physical investment demand. The demand is not disappearing. It is migrating from one category to another, and the aggregate remains above what the supply side can deliver. I want to spend some time on the price action itself. Because the silver market in early 2026 has delivered a level of volatility that has been genuinely extraordinary, even by silver's historically volatile standards. Silver prices more than doubled over the past 12 months, driven by the confluence of structural deficit dynamics, geopolitical uncertainty, monetary policy expectations, and a wave of retail and institutional investment inflows that overwhelmed the market's ability to absorb them in an orderly fashion. The rally carried silver through the psychologically critical 100 per ounce mark for the first time in history, a level that compressed the gold to silver ratio below 50 for the first time since 2012. That ratio compression itself was a significant signal. For much of the past decade, the gold to silver ratio fluctuated between 70 and 90, reflecting a market consensus that silver's monetary premium was structurally lower than gold, and that the white metal industrial demand profile introduced downside risks during economic slowdowns. A ratio below 50 implies a fundamental reassessment of that consensus. A recognition that silver's dual nature as both an industrial commodity and a monetary metal makes it uniquely positioned in an environment where both industrial demand and investment demand are elevated simultaneously. However, the rally did not proceed in a straight line, and the correction that followed the January highs was as violent as the advance that preceded it. Silver suffered the largest single-day price decline on record in late January, a move that some market participants have described as making the metal untradeable in the near term. That characterization, while hyperbolic, captures something real about the current market microstructure. When a commodity doubles in price and then corrects by 20 to 25% in a matter of days, the margin calls and forced liquidations that follow disrupt the normal functioning of the derivatives markets. Open interest collapses. Bid-ask spreads widen. Liquidity evaporates at precisely the moments when it is most needed, and the resulting environment rewards only those participants with the conviction and the balance sheet strength to weather the drawdowns without being forced to sell. The correction pushed silver below $80 per ounce from its peak above $100, a retracement that eliminated a substantial amount of speculative length from the futures market. But what I find more interesting than the correction itself is what happened afterward. Silver did not collapse further. It did not enter a sustained downtrend. It stabilized, consolidated, and began forming what technical analysts describe as a support base in the high 70s to low 80s range. This price behavior is consistent with a market where the buying interest on pullbacks is sufficient to absorb the selling pressure generated by profit-taking and forced liquidation. It suggests that the demand underpinning the rally is not purely speculative, but has a structural component that provides a floor beneath which prices struggle to fall for any sustained period. Whether that floor holds through the remainder of 2026 will depend on the interplay of the supply and demand factors I have described. But the early evidence suggests that the correction was a healthy pause within a broader uptrend, rather than the beginning of a bearish reversal. Now, I want to connect the SHFE inventory data back to the broader physical market tightness that the Silver Institute's report identifies as one of the key supporting factors for silver prices in 2026. The Institute specifically highlights tight physical supply in London as a persistent market condition that has remained firmly in place so far this year. The London Bullion Market Association vaults, which serve as the primary storage location for silver backing the global over-the-counter market, and the iShares Silver Trust ETF, have seen their reported holdings decline substantially over the past 4 years. While the LBMA does not publish daily inventory data with the same granularity as COMEX or SHFE, the periodic reports and estimates from market participants paint a picture of declining availability. Silver available for immediate delivery in London, often referred to as free float, after deducting metal committed to ETF backing and other allocated purposes, has been estimated at levels that some analysts describe as critically low relative to the volume of daily trading activity in the London market. This matters enormously because London is the center of the global physical silver market. It is where the largest volume of physical metal changes hands, where the daily fixing price is determined, and where the contractual obligations of the over-the-counter market are ultimately settled through physical delivery. When London supply is tight, it creates a ripple effect that propagates through every other physical market globally. Dealers in Asia, the Middle East, and the Americas who source metal from London face longer delivery times, higher premiums, and greater uncertainty about their ability to fill orders in a timely manner. Those conditions, in turn, reinforce the very investment demand that is contributing to the tightness in the first place. When market participants see inventories declining and delivery times extending, it validates their thesis that physical silver is becoming genuinely scarce and encourages them to accelerate their accumulation. This is the reflexive dynamic that makes physical commodity markets so different from financial markets. Tightness breeds urgency. Urgency breeds demand. Demand breeds further tightness. The loop continues until either supply catches up, which requires new mine production that takes years to develop, or demand is destroyed by prices rising to levels that change behavior across a sufficient number of end users, or inventories are exhausted entirely, which would trigger a delivery default and a disorderly repricing event. The Silver Institute's report identifies several additional factors that it believes will continue to support silver prices in 2026 beyond the structural deficit itself. A volatile geopolitical backdrop remains a persistent feature of the global landscape. Without speculating on specific outcomes, I think it is fair to observe that the number of active and potential conflict zones, trade disputes, and diplomatic tensions globally is elevated relative to historical norms, and that this environment tends to support demand for tangible assets that are perceived as stores of value outside the traditional financial system. U.S. policy uncertainty is another factor cited by the Institute. The trajectory of fiscal policy, trade policy, and regulatory policy in the world's largest economy has implications for everything, from interest rate expectations to currency valuations to industrial supply chains. That uncertainty creates hedging demand among both institutional and retail investors, and precious metals are among the primary vehicles through which that hedging is expressed. And concerns over the Federal Reserve's independence, a factor that would have seemed exotic just a few years ago, have entered the mainstream discourse in a way that directly supports the thesis for hard asset ownership. Whether or not those concerns are justified on their merits, the perception of politicization of monetary policy erodes confidence in the stability of the currency and the credibility of the inflation targeting framework. That erosion of confidence, even if it affects only a small percentage of total financial assets, can generate enormous flows into a market as small as silver, where total annual production has a dollar value that is a tiny fraction of global financial assets. Let me address the cumulative deficit issue because I think it is the single most important analytical lens through which to view the current silver market. The Silver Institute's data shows that the global silver market has been in deficit every year since 2021. The cumulative shortfall over this 6-year period, when you aggregate the annual deficits from 2021 through the projected 2026 figure of 67 million ounces, is approaching 1 billion ounces. The exact figure depends on which data source you use and how you account for revisions to historical estimates, but the order of magnitude is clear. Roughly 1 billion ounces of silver demand over the past 6 years has been met not by current production, but by the drawdown of above-ground inventories. That is roughly equivalent to 1 full year of total global mine production being consumed from stockpiles rather than being replaced by new supply. And the inventory data from SHFE, COMEX, and the LBMA confirms this arithmetic in physical terms. The metal has left the vaults. It has been consumed by industrial processes, absorbed by investment demand, or redirected into private holdings where it is no longer available for delivery against exchange contracts. It is not coming back to the vaults unless prices rise to levels that incentivize liquidation from current holders, or unless mine production increases dramatically, or unless demand falls substantially. None of those conditions appear imminent based on current data. The implications of this cumulative drawdown extend beyond the silver market itself. They raise questions about the resilience of the commodity exchange system, which depends on the availability of deliverable inventory to maintain the credibility of futures contracts. When the ratio of open interest to deliverable inventory becomes stretched, the theoretical possibility of a delivery squeeze, where holders of long contracts demand physical delivery, and the exchange cannot source sufficient metal to satisfy all claims, transitions from theoretical to practical. I want to be careful here because delivery squeezes are rare events, and the exchange mechanisms for managing delivery obligations, including position limits, delivery windows, and cash settlement provisions, are specifically designed to prevent such outcomes. But the design of those mechanisms assumes a certain level of available inventory, and when that inventory falls 89% from its peak, the assumptions underlying the system come under increasing strain. I'm not predicting a delivery default. I'm observing that the margin of safety within the system has narrowed substantially, and that this narrowing is itself a form of systemic risk that did not exist 5 years ago. For investors considering their positioning in this environment, I want to offer several observations that I believe are more useful than directional price predictions. First, the physical market and the paper market are increasingly telling different stories. The futures price of silver, while elevated, is set by the interaction of leveraged traders, algorithmic systems, and market makers whose positions are largely synthetic. The physical price of silver, as expressed through dealer premiums, delivery wait times, and exchange inventory levels, reflects the actual availability of metal for consumption and investment. When these two prices diverge, when physical premiums expand and inventories contract, even as the futures price is stable or declining, it is the physical market that is providing the more reliable signal about true supply and demand conditions. Second, the composition of demand matters as much as the level. The Silver Institute's projection of a 20% increase in physical investment demand alongside declines in jewelry and silverware consumption tells us that the price-sensitive demand is doing what it should, which is contracting in response to higher prices, but that the conviction-driven demand is intensifying despite those same higher prices. This pattern is characteristic of markets in the late stages of a repricing cycle, where the marginal buyer is motivated not by value relative to history, but by the expectation that current prices still understate future scarcity. Whether that expectation proves correct will ultimately determine whether the current price level is sustainable. Third, the supply response, while positive, is arriving at a pace that is measured in years, not months. The Silver Institute's projection of 1.05 billion ounces of total supply in 2026 represents progress, but the trajectory of supply growth would need to accelerate meaningfully and sustain that acceleration for several consecutive years to close the cumulative deficit. Mine development timelines, grade constraints, byproduct dependencies, and jurisdictional risks all argue against a rapid supply response. Fourth, the thrifting and substitution dynamics in industrial demand, particularly solar photovoltaics, are beginning to bite. This is a genuinely important development that the bullish consensus has tended to underweight. If solar silver demand has indeed plateaued or begun to decline on a per gigawatt basis, and if the rate of thrifting continues to accelerate as silver prices incentivize further investment in silver reduction technologies, the industrial demand pillar of the bull thesis could weaken over a multi-year horizon. This does not invalidate the deficit story for 2026 or 2027, but it does suggest that the structural deficit may narrow more rapidly than the most bullish projections assume if technology continues to evolve. I also want to draw attention to a dynamic that the Silver Institute's report touches on only briefly, but that I believe will become increasingly important as the year progresses. The report notes that the global silver market will continue to rely on the release of bullion from above-ground inventories to bridge the gap between supply and demand. That phrasing, continue to rely on the release of bullion from above-ground inventories, is a polite way of describing a market that is consuming its own reserves. And the question that every participant in this market needs to answer for themselves is how long can that consumption continue? And what happens when the reserves are no longer sufficient to fill the gap? The answer depends on two variables that are inherently uncertain. The first is the total size of above-ground silver inventories, which is not precisely known. Exchange-monitored stocks, which are the most visible and frequently cited, represent only a fraction of total above-ground silver. Private holdings, government reserves, dealer inventories, and silver held in non-exchange vaults are all significant, but poorly quantified. Estimates of total above-ground silver inventory range from 1.5 billion to over 2.5 billion ounces, depending on the source and methodology, a range wide enough to accommodate meaningfully different conclusions about how long current deficit rates can persist. The second variable is the willingness of current holders to release their metal at prevailing prices. If the entities and individuals holding above-ground silver believe that prices will continue to rise, they will hold rather than sell, effectively reducing the available supply, even if the total stock remains physically intact. This behavioral dimension of inventory management is what makes physical commodity markets so much more complex than financial markets. The metal exists, but its availability for market delivery is a function of human decision-making that cannot be modeled with precision. The convergence of these factors, the SHFE inventory collapse, the sixth consecutive deficit year, the surge in physical investment demand, the thrifting dynamics in industrial consumption, the tight London market, the volatile geopolitical environment, the policy uncertainty surrounding major central banks, creates a market environment that I would characterize as structurally supported but tactically treacherous. The long-term thesis for silver, grounded in deficit arithmetic and inventory drawdowns, remains as compelling as it has been at any point in this cycle. The short-term trading environment, characterized by extreme volatility, record single-day price swings, and liquidity conditions that have led some participants to describe the market as untradeable, demands respect for risk management and position sizing that matches your time horizon and conviction level. For those who are building long-term positions in physical silver, the SHFE data in the Silver Institute as deficit projections provide fundamental support for the thesis that current prices, while historically elevated, reflect genuine scarcity rather than speculative excess. For those who are trading silver through leveraged instruments, the volatility profile of this market in early 2026 is unlike anything we have seen in previous cycles, and the appropriate response is to reduce position sizes, widen stops, and accept that the market's ability to deliver 20% moves in either direction within a single week is not a bug, but a feature of a market where structural tightness is colliding with speculative intensity. And for those who are evaluating silver mining equities as a way to gain leveraged exposure to the metal, the key variables to monitor are AISC trajectories, production growth rates, jurisdictional stability, and management's ability to convert higher revenue per ounce into sustainable free cash flow rather than dissipating it through cost inflation or ill-timed capital expenditure programs. The companies that will outperform in this environment are the ones that can demonstrate operational discipline when the price is running and financial resilience when the inevitable corrections arrive. Let me close by returning to the SHFE inventory figure that opened this analysis, because I believe it contains within it a truth that is easy to overlook in the noise of daily price movements and quarterly earnings reports. When an exchange that serves the world's second largest economy sees its silver inventories fall 89% in 5 years, it is not a data point. It is a verdict. It is the physical market's verdict on the adequacy of current supply relative to current demand. It is a verdict that has been rendered not by speculators or analysts or commentators, but by the actual withdrawal of real metal from real vaults by real consumers and investors who needed that silver for real purposes. You can debate price targets. You can debate the gold to silver ratio. You can debate whether $100 silver was a blow-off top or a waypoint on the path to higher levels. But you cannot debate the inventory data. The metal is either in the vault or it is not. And at 342 tons compared to a peak of 3,091 tons, the message from Shanghai's vaults is unequivocal. The silver is leaving. It is leaving faster than it is being replaced. And it has been doing so consistently, relentlessly, and measurably for 6 consecutive years. This is Mr. AG, the Asian guy. It is Wednesday, February 12th, 2026. Silver is consolidating after its first ever breach of $100 per ounce. Shanghai inventories are at decade lows. London supply is tight. The deficit is projected for its 6th consecutive year at 67 million ounces. Physical investment demand is surging 20%. And the cumulative shortfall over this cycle is approaching 1 billion ounces of silver that has been consumed from above-ground stockpiles and not replaced by new production. If this analysis helped you understand the structural dynamics beneath the price volatility, do me a favor, like the video, subscribe to the channel, and share this with anyone who needs the data behind the narrative rather than just the narrative itself. Stay sharp, stay analytical, and I will see you in the next one.